The financial world just felt a tremor, and the aftershocks are creating a seismic shift in wealth. This is not a drill. Moments ago, the Federal Reserve delivered an immediate rate cut, triggering an unprecedented market rally. We're talking immediate, broad-based gains across major indices. The S&P 500 is surging. The Dow Jones Industrial Average just breached historic levels, and the Nasdaq is seeing its strongest momentum in weeks. This is the inflection point we've been tracking, and for the astute investor, it presents a critical window for urgent wealth protection and aggressive portfolio positioning into high-yield passive income. The shift has begun. Are you ready to capitalize? Let's cut through the noise and get straight to the facts. The Federal Reserve has officially reduced the Fed funds target range by 25 basis points, settling it between 3.5% and 3.75%. This is a third consecutive rate cut this year, following similar moves in September and October. What's crucial here isn't just the cut itself, which was broadly expected, but the nuance of the accompanying statement. While Powell emphasized downside labor market risks as an impetus for the rate cut, the Fed also signaled a cautious stance towards further aggressive cuts, leaning toward a wait-and-see mode for 2026. This delicate balance, a cut now, but restraint later, is what's truly shaping the immediate opportunities and future strategies. The market's response was nothing short of electric. The S&P 500 surged by 0.67%. The Dow Jones Industrial Average gained 1.05%, and the Nasdaq 100 climbed 0.42% in a single day. But beyond the large caps, the Russell 2000, representing smaller companies, hit a new record high. This tells us the rally isn't confined to tech giants. It's a broad-based capital redeployment. Crucially, we also saw an unexpected injection of liquidity. The Fed announced it would purchase $40 billion of Treasury bills this month to rebuild reserves. This simultaneous move, rate cut and liquidity boost, is a powerful one, signaling proactive monetary easing and setting the stage for significant capital shifts. Now, let's talk about where the smart money is moving for high-yield passive income. Front and center, real estate investment trusts, or REITs. Historically, U.S. REITs have consistently outperformed broader U.S. stocks following Fed easing cycles. In the 12 months after a rate cut, U.S. REITs delivered an annualized return of 9.48%, compared to 7.57% for U.S. stocks. Why this outperformance? Lower interest rates directly reduce borrowing costs for REITs, enhancing property values, lowering financing expenses, and strengthening their dividend-paying business models. This is a fundamental data-backed advantage. Specifically, within the REIT sector, we see particular strength in data centers, telecom infrastructure, and healthcare REITs due to their long-duration leases and capital-intensive models. Beyond REITs, dividend stocks become increasingly attractive as bond yields fall. Consider established players like NN and REIT, boasting a 6.01% dividend yield, or Verizon Communications with its 6.69% yield as it undergoes a multi-year efficiency reset. Amcor, a leader in packaging, offers a 6.27% yield, benefiting from the booming online food delivery and e-commerce markets. For diversified exposure, high-yield ETFs like JP Morgan Equity Premium Income ETF JEPI, SPDR Portfolio S&P 500 High Dividend ETF SPYD, and Global X Nasdaq 100 Covered Call ETF QYLD offer structured approaches to consistent income. Remember, this is educational analysis, not direct financial advice. Another powerful avenue for passive income is high-yield corporate bonds. Historically, the Bloomberg U.S. High Yield Index has returned an average of 4.44% in the 18 months following the Fed's first rate cut in an easing cycle, provided it's not followed by a recession. Our current analysis suggests the Fed's dovish shift increases the likelihood of avoiding a near-term recession, making these bonds more attractive. However, it's crucial to understand that high-yield bonds carry a higher risk of default. They are issued by companies with greater estimated default risk, so they offer higher interest rates to compensate investors. This demands a balanced portfolio approach, carefully integrating these higher-yielding assets with more stable government bonds. Now let's zoom out. The market isn't just about the Fed, it's about geopolitics. In 2025, geopolitical conflicts and uncertainties, such as U.S. tariff policy and the Russia-Ukraine conflict, are having a stronger impact on the global mood and financial markets. We are in an era of multipolar geopolitics, with the U.S. and China vying for influence, impacting trade relations, energy prices, and investment decisions. Industrial decarbonization policies are accelerating globally, creating new opportunities and risks in sectors like energy and resources, infrastructure, and electrified transport. These macro forces necessitate an agile strategy, identifying sectors resilient to or even benefiting from these global shifts. This isn't just retail excitement. Institutional capital is actively repositioning. Institutional investors have been patiently waiting for this type of easing monetary policy environment to deploy assets into real estate. This signals a wave of sophisticated money flowing into these income-generating assets. Furthermore, while large caps have rallied, small cap stocks remain significantly undervalued, trading at a 15% discount to their fair value compared to large and mid caps. This presents a distinct opportunity for strategic investors to identify undervalued gems that stand to benefit disproportionately from lower borrowing costs and a strengthening economy. This is where true alpha is found. So, what's the immediate strategy? First, consider rotating from cash into high-quality bonds, especially 2 to 5-year maturities, to lock in yields. As cash yields decline post-cut, bonds gain in relative value and offer potential for capital appreciation. Second, prioritize REITs, particularly those in data centers, telecom, and healthcare, for their defensive and income-generating characteristics. Third, selectively integrate high-yield corporate bonds, focusing on strong credit fundamentals to enhance income. Fourth, scout for dividend growth stocks and high-yield ETFs that demonstrate resilience and fundamental strength beyond just their yield. This is not about chasing yield blindly, but intelligently positioning your portfolio for predictable, substantial income. The Fed's rate cut has ignited a market rally and opened up a strategic window for high-yield passive income. This is not about speculative gambling. It's about disciplined, data-driven positioning. Understand the Fed signals, analyze institutional flows, and identify the assets poised to thrive in this new environment. Your financial future demands proactive engagement, not passive observation. Review your portfolio, consult your financial professional, and make the strategic adjustments needed to protect and grow your wealth. The next phase of wealth creation is here. Are you strategically positioned? Thank you for joining me. Until next time, stay vigilant, stay strategic, and may your portfolios be green.